Hi, most people who have traded my strategies in the past know that I stick to the KISS principle. Simplicity, in most cases, wins hands down over complicated and over-optimized trading strategies. It might therefore come as a bit of a surprise when taking an initial look at my KPL strategy. Looks are deceiving though, because it is in fact a very simple strategy. The KPL, or Key Price Level strategy, looks for clusters of support and resistance using a range of useful indicators, including pivot points, multi-time frame highs and lows, the average daily range, moving averages, and Fibonacci levels. These indicators give the strategy an appearance of complexity, but really nothing could be further from the truth. The basis of the strategy lies in the premise that price never moves in a straight line. It is always moving between these key price levels, sometimes breaking through them, but more often than not, rebounding off them. On any given time frame, the market is trending on average only 25% to 30% of the time. For the rest of the time, price is oscillating between these zones of support and resistance. So by carefully observing where these zones are located, as traders we are able to predict with quite some accuracy where market participants may, for instance, choose to take profit, or at the very least pause and take stock of the situation. This easing of momentum often causes short-term traders to exit positions, which results in a pullback of price. It's at these times that an opportunity exists or opens up for knowledgeable traders. But of course we shouldn't just blindly accept that a single historical support or resistance level will necessarily cause a hold up in price. The more of these levels there are in close proximity to each other, the stronger the barrier is likely to be. It is these clusters of support and resistance which entice me to trade. To help me identify these clusters, I use a number of freely available open source indicators which draw the relevant key price levels on the chart. Let's quickly look at some of these indicators. The MTF high-low indicator plots the daily, weekly and monthly highs and lows. Now, in general, I don't use the daily settings because in a trending market, these levels are constantly changing. Bear in mind that current weekly and monthly high and low levels may also be changing dynamically, especially in the early stages of these periods. It's often best to use these levels only when they coincide with other key price levels. The auto pivot indicator prints daily, weekly and monthly pivot levels on the chart. And once again, I don't use the daily pivots because Forex is a 24-hour market, and for accurate calculation, pivots require a closing time. In my time zone, for instance, the market opens on Monday morning and closes on Saturday morning, meaning that weekly pivots can be calculated accurately, and for this reason I can also incorporate monthly pivots. I also use a personal adaptation of the super trend indicator to identify dynamic levels of support and resistance. Price often rebounds from this indicator on its own, and if found in confluence with other key price levels, the signal becomes even stronger. The WELX AMA indicator is an adaptive moving average originally developed by systems analyst and former rocket scientist Perry Kaufman in the 1990s, and I use it to help identify ranging or trending markets. Red dots signal a downtrending market, while green dots signal an uptrend. A line displaying no dots indicates price consolidation. Price often bounces from this moving average as well. The daily range indicator gives me an idea of how far price has travelled in the course of a session relative to its average daily range. If price is at one of the ADR extremes and is in confluence with another level of support and resistance, then a retracement is highly possible. And finally, I use the MT4 fib retracement and expansion tools to look for Fibonacci confluence with any of the other support and resistance levels. To trade, I use the VT FlexiTrade EA to enter and manage trades, and two other filtration indicators, the VT Correlator, which I use to limit risk by alerting me to pairs that move in either similar or opposite directions, and the NewsCal, which warns of upcoming news announcements which may cause price spikes through S&R levels. Let's check out some examples of how I use a combination of these indicators to signal possible entry points. The first example is a long setup on the 15-minute chart of the CAD yen. Here I've drawn Fibonacci retracements, and if you look carefully you'll see that the 61.8 level is in close proximity to the lower super T line. This forms an area of confluence which may offer significant support, at least temporarily. Below this support level is another area of confluence. Here we have the weekly R2 pivot in confluence with the monthly R1. This is another probable support area. Now, I don't want to miss the entry, so I'm going to enter a limit order to go long at the first support level and place a stop loss behind the second. I do this by drawing a horizontal line just in front of the Super T and naming it entry. Using the FlexiTrade EA, if price passes through this line, a limit order to go long will be sent to the broker. You can see that as soon as I click OK on the horizontal line properties, a virtual pending order is displayed, including a stop loss and 4 profit objectives. Nothing at this stage has been sent to the broker. As soon as price reaches the entry level, the order is sent and the dashed pending order lines change to solid. So after spending around 4 hours bouncing around this support level, price eventually pulls back to the upper Super T to form a new daily high and deliver some profit. Let's now look at the same pair on the same time period. In fact, a setup to the short side had occurred immediately following the long. Here we are as price rebounds off the previous monthly high and Super T. We draw the fib retracements as before, but this time from the swing high down to the swing low. Now we can see that there's likely to be strong resistance at the upper Super T and the 61.8 level. By the way, it wouldn't matter if it was the 50% or 38.2 level that formed a ceiling. There would still be confluence around a significant Fibonacci number. Once again, we draw a horizontal line and rename it entry. As soon as price hits this line, we are entered short into the market. A stop loss is being protected by the previous day's high, and take profit levels give us plenty of scope to scale out our position if price returns to the downside. Here the first target is hit, and the second. And finally a third, before support formed by the monthly R1 and R2 pivots cause a rebound to the upside. The KPL is a very simple strategy which can deliver quite significant profit if used with common sense. Watch the correlation and look out for news. Good trading and good luck.